All right, trading previous day's highs and lows. Now again, looking at this example here, this is pretty much what I was trying to get people to look at when I came on the scenes in Baby Pips. And I said, look, let's take a look at the previous day's highs and lows and see if there's any reversal characteristics there. And again, it's to get people thinking about how the market moves after running buy stops and sell stops. For the most part, the neophytes that haunt these forums, they're always in confusion. They're always trying to figure out what they should be doing, and they're chasing things that don't lead to greater understanding. So generic things like time of day, highs or lows formed in London, the opposite end of the range in London close forms. New York is generally a continuation. Rarely will it become a reversal in New York, but times when it reaches its higher time frame PD array, that's when you anticipate that New York session becoming a catalyst for reversal. Well, when we look at previous day's highs and lows, every single trading day, you should always refer to how price traded today after the close in relationship to the previous day's range. Did we work the daily high or the daily low of the previous day, or the day prior to it, or the day prior to it? So what you're doing is you're always referring to the last 3 days, counting today as one day. You'll see that there's a lot of influence over that liquidity that's resting above or below those respective days' highs and lows. Now there's two circumstances that when we're looking to fade the price beyond the previous day's range, there's characteristics, there's things that we look for. And in my opinion, this is the kind of like the crown jewel of this particular teaching. During expansion swings, there are smaller retracements that typically create opportunities where the previous day's low is rated, then price rallies higher. In opposing expansion swings, there are retracements that create opportunities where the previous day's high is rated, then price declines. Obviously, it's the concept of turtle soup, which is a false break above an old high or a false break below an old low, but it's one step further than that. Okay, so when we're looking at previous day's highs and lows, when is it that I'm really looking to trade below the previous day's low to be a buyer or above the previous day's high as a seller? But when I'm looking to trade the previous day's low and I'm anticipating higher prices, in this example, you can see price was moving higher as a part of a larger expansion swing, and during a normal retracement lower into a fair value gap, price finds buyers under the previous day's low. Using the previous day's low and anticipating a market reversal after the previous day's low is rated, one can be a buyer intraday. So take a look at this candle right here. This candle's open, trades down and closes in the fair value gap, and then rallies up and has a higher close. The candle prior to it, notice it trades down below that candle's low. So you could already be thinking about being a buyer below that candle's low because the fair value gap exists below it and it's during a retracement. Your understanding of institutional order flow and the higher time frames are going to assist you here, because while markets generally retrace, those retracements, what you're looking for is a move down below the previous day's low and also into a discount array. Like in this case, it's a fair value gap. Price trades under the previous day's low. That's where you're going to find buyers. The market's going to come in with a great deal of institutional sponsorship, and they'll send price higher intraday. Now, we look for confluences of PD arrays to support the idea of buying under a previous day's low, but we don't simply buy under the previous day's low on the sole basis that price moves below the previous day's low. There has to be context behind it all. Now, trading previous day's highs, if I'm bearish on the market and institutional order flow is suggested to go lower in the higher time frames, I like to look for reasons to see price move up into a short-term premium array, and then having, and like we see in this example here, price was moving lower as part of a larger expansion swing. During a normal retracement higher after a fair value gap was filled, notice the gap has already been filled, but after that gap has been filled, price finds sellers above a previous day's high. This candle here trades above its previous candle. When price trades above that previous day's high, the market finds sellers, and you can be a seller that day. Now, obviously, again, using context, not just simply looking at, okay, well, we're above yesterday's high, so I'm going to be a seller. It doesn't work like that. You have to have the understanding of what institutional order flow is indicating. In this case, we're looking for institutional order flow on the weekly, the daily, or 4-hour, suggesting prices are going to go lower. If we have that and price trades up into a premium array and it's during a retracement, in other words, it's been moving lower and now we're having a little bit of a retracement or a bounce up. Once it goes to a premium array, that's what you couple it with. Then if it trades above the previous day's candle high, you could be a seller right above that high.